and gentlemen, we are live. Welcome to the Dylan Holy Experience midweek market recap. More specifically, it is 6:01 p.m. Pacific Standard Time, 9:01 Eastern Standard Time for those of you on the East Coast. We always have nothing but love for our East Coast viewers. And let's just jump into it. Stock futures are flat as Wall Street weighs the likelihood of higher rate hikes. And you bet your sweet bucket, we're going to be talking a little bit about that later. I guess I just spoiled it just a wee bit. But hey, what's the Dylan Holy Experience without a bit of spoilers? U.S. stock futures were flat on Wednesday as traders processed fresh job market data and comments from Federal Reserve Chairman Jerome Powell. Dow Jones Industrial Average futures fell by 6 points or 0.02%. The S&P 500 futures and NASDAQ 100 futures dipped by 0.01 and 0.03% respectively. During the regular session, the Dow Jones dipped 58.06 points or 0.18%, marking its second negative session in a row. Meanwhile, the S&P 500 rose 0.14% and 0.40% respectively. So if we take a look actually at what has happened over the last day, basically since there was a cheeky little speech that Jerome Powell gave, and it threw the market into a frenzy. And we'll talk about that a little after we break down what's going on with the Dow Jones. But if we take a look here, the Dow Jones sold off, and let's just go to the daily. The Dow Jones sold off. Let's get rid of the Ichi as well. The Dow Jones sold off like 574 points, dude. So it did not react too fondly to what Federal Reserve Chairman Jerome Powell said. S&P 500 fell 1.5% yesterday. Obviously, it has rebounded a wee bit. It clearly rose about 0.14%. So, it was a green day for the S&P 500, but, higher interest rates for a longer amount of time is definitely not the most fantastic thing for most assets. And I'll be covering one asset class that I think is about to start getting down a little more horrendous than it has been recently. But let's break down this Federal Reserve Chairman speech. Powell says interest rates are likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes, the central bank leader said in prepared remarks for appearances this week on Capitol Hill. Now, these are prepared remarks, but they are a year old. It has come out that Federal Reserve Chairman Jerome Powell literally used the exact same speech that he did 1 year ago. But no, I mean, again, I've always been someone who is all for tight monetary policy. I think quantitative easing is bullshit, dude. I understand, spurring growth, but I do not like quantitative easing. I definitely think having credit being more difficult to get typically gives more moderation in the marketplace. Obviously, how boom and bust cycles work, there's rarely a happy medium. There's rarely moderation in the marketplace, but dare to dream, right? I think them raising interest rates higher than previously anticipated, I don't think that's necessarily an issue. They said that they were going to raise it to about a 5.1 to 5.2 terminal rate, but now they're probably going to bring that higher. So maybe 5.4, 5.5%. We saw 2-year treasury bonds hit 5% for the first time in over 2 decades, I think. One of these factors that is having Jerome Powell say that rates are likely to be higher than previously anticipated is still what many consider a relatively hot job market. ADP said that its private payrolls in February of 2023 rose by 242,000, better than expected. The estimates were at 205,000, so ADP is showing payrolls increasing again after last month. So January, it had a killer January as well. The U3 index, which is what most major financial institutions and the White House use as their unemployment numbers. But I did want everyone to take a look at the U6 unemployment rate. Now, this is the unemployment rate that I like to take a look at because this is all workers, all discouraged workers, and all other marginally attached workers. And the U6 adds on workers who are part-time purely for economic reasons. So this includes basically everyone that's not working, not just people that have been out of the game for a month and they're no longer looking for a job. I'm talking every single able-bodied American that is not working. The U6 index, while nowhere near its COVID 2020 pandemic highs or the highs of the 2008 recession, the great financial crisis, nowhere near those levels. But when they were touting a record low unemployment rate in January of 2023, the U6 unemployment rate actually rose. And obviously it's again not at these crazy downturn levels, but it's significant. It's like if the official U3 unemployment rate is at 3.4%, the lowest since 1969. The U6 unemployment rate is at 6.6%. It is double what they are. The unemployment rate is double what the government is saying, dude. It is literally double. If we take a look at the U6 compared to COVID, the U3 index was at 14.7%. The U6 was at 22.9%. So there was like an 8 percentage point difference there. If we take a look at the great financial crisis, the recession, if we take a wee gander there, the U3 index, 9.9%. The U6 index at 17.2%, nearly an 8% move again, an 8% disconnect. So there's always going to be a disconnect. And they want to give people the lowest possible number. They want to make sure it's record low unemployment, which from a U3 standpoint, sure. But from a U6 standpoint, it'd be double. And they're lying to us. They are lying to us. But that's one of the factors that goes into the Federal Reserve making their decisions. And at least for right now, according to automatic data processing, which I am an active shareholder in, just for the sake of being totally transparent, they're saying there is a trade-off in the labor market right now. We are seeing robust hiring, which is good for the economy and workers, but pay growth is still quite elevated. The modest slowdown in pay increases on its own is unlikely to drive down inflation rapidly in the near term. But I'm sure them bumping interest rates to 5.5%, I'm sure that'll pump the brakes a wee bit. By sector, leisure and hospitality led job growth with 83,000 additions. Financial activities added 62,000, while manufacturing showed a robust 43,000 gain as the industry benefited from a mild winter. Other areas showing increases including education and health services, 35,000. The other services category was 34,000, and natural resources and mining added 25,000. Professional and business services lost 36,000 jobs, while construction was down 16,000 employees. Interesting. So construction seems to be slowing down. Maybe it's the fact that there are less houses being built because there are less houses being purchased because interest rates are so high. But who knows? The ADP report serves as a precursor to the more closely followed non-farm payrolls report the Labor Department is scheduled to release on Friday. So you bet your sweet bucket the Dylan Holy Experience is going to be covering that as soon as that comes out. And the best place to find the most up-to-date information on the Dylan Holy Experience is twitter.com/RealDylanHoly or at Real Dylan Holy. We are hand parsing the internet to give you the news that you need to see. And all this stuff that I talk about on the midweek market recap, spoiler alert, I talk about it here first. I also do key takeaways on each and every market day. So whenever the stock market is open, the Dylan Holy Experience is open, and we are constantly giving you news. And of course, there are some special occasions on weekends when there's something that tickles my fancy. And I put it up for the millions to see. So yeah, be sure to give me a follow at Real Dylan Holy, and let's get back to this whole thing. So once again, The Labor Department's going to be releasing their numbers for February on Friday, so we're going to be taking a wee gander there. The Labor Department estimated payrolls rise by 517,000 in January, more than 4 times what ADP reported. Private payrolls are bouncing back after a disappointing January, adds more uncertainty to the debate of when higher rates will lead to demonstrably slower hiring. Friday's non-farm payrolls report will provide investors additional clarity, but all signs point to the labor market remaining resilient ahead of the next Fed decision. Friday's report is expected to show growth of 225,000 jobs in February, with the unemployment rate holding steady at 3.4% and the U6 holding steady at 6.6%. But that's white privilege. The real unemployment rate, that's white privilege. That we're not going to talk about that one. We're only going to talk about the U3. Let's move over into the mythical world of WWE, where WWE is in talks with state gambling regulators to legalize sports betting on scripted match results. Finally, baby! Finally, damn it, I can run an 8-leg parlay on WrestleMania, dude. If I can, I'm going to run an 8-leg parlay on WrestleMania, dude. That's going to be fucking sweet. WWE has held discussions with state gambling regulators in Colorado and Michigan to legalize being scripted or betting on scripted match results, sources say. WWE is working with Ernst & Young, commonly known as EW, to secure match results so they won't leak to the public. WWE creative executives don't plan to inform wrestlers on who will win until hours before a match. WWE aims to have major sports betting companies offer bets on high-profile matches. Now, this coincides with a real, and this has been public knowledge because everyone has to disclose their stock holdings and their investments and stuff like that. But Vince McMahon is a significant minority shareholder in DraftKings, so this just makes sense. As a WWE fan, listen, y'all, I don't really watch sports. I don't really watch the NFL or MLB or the NBA or anything like that. WWE's my shit, homie. So if I can run 8-leg parlays on WWE now on WrestleMania, Extreme Rules, Backlash, you bet your sweet bucket I'm going to. So I welcome this. I think this is going to be fantastic. And the one issue is, like, are they really going to secure the match results and everything? Because that really is the big thing. Like as much as I love it, come on. It's scripted. It's choreographed. That shit still hurts. Like, I'm sure. Listen, bro, diving through a fucking, like from a 20-foot ladder through a table, I'm sure it doesn't feel the greatest, you know? But no, I think my one worry with it is how are they going to secure these match results? But other than that, I welcome it, dude. I view this as an absolute win. But here's not an absolute win. SiriusXM is planning on cutting 8% of its workforce as a broader part of its reorganization. SiriusXM said it is cutting 8% of its workforce, or 475 roles, as the car audio subscription company has been looking to reorganize its business. They were overvalued. Let's see what this company is valued at right now. Let's see their price earnings ratio. Actually, you know what? Their price earnings ratio is not bad. It's 12.64. Let's take a wee. Oh, their debt to equity, not too fantastic. Negative 282.07%. Their net margin is actually solid. It is 13.47. So that is better than a lot of other companies. Dividend yield's 2.5%. But if they're looking to do like a broader restructuring, I definitely think that I think a dividend cut is the first place to go. But yeah, obviously to the 475 employees laid off by SiriusXM, Dylan Holy Experience wishes you nothing but the best of luck in your future endeavors. And y'all, I think y'all are going to work it out. I think y'all got it. I think y'all are going to be good. But once again, very rough to hear about these layoffs happening. But that's a contraction period for you, man. It sucks. Speaking of contraction periods, Rivian shares have fallen as the EV maker looks to raise $1.3 billion amid growing demand concerns. Rivian plans to sell $1.3 billion in cash or stock via a sale of convertible notes. it needs a shit ton of money. So shares of Rivian closed down over 14% on Tuesday. And if we take a cheeky look over at my Twitter, it's actually down 75% year to date. So this was yesterday's performance. If we take a further look today at what's going on with Rivian, it's down a further 0.5%. So it's definitely it hit a 52-week low today. That's all you need to know. It's down. Yeah. Rivian's down horrendous. They've been hemorrhaging cash for a long while. Like if we look at their earnings per share, it's negative $7.39 per share. It's trading at $15.05 right now. So it's hemorrhaging money, and they're probably going to end up needing to find a buyer within the next few years. In my humble opinion, I think that's going to be the case. But here's a tech company that is not hemorrhaging money, and that is Spotify, which it's Spotify listeners, at least in this quarter, the Spotify team, the Spotify management team is anticipating that it is going to cross 500 million monthly active users. Over 500 million people are going to be using Spotify, at least according to projections, which is massive. I mean, that's huge stuff, man. Like I use Spotify myself, definitely the most based of all of the music streaming apps. I definitely wish they had a better monetization model for independent artists, but I use Spotify. I like it over Apple Music, and I sure as hell like it more than Pandora and SiriusXM. But yeah, Spotify has hit 500 million users. Absolutely massive stuff, man. They've also shared an update to its annual music royalties report, noting that the number of artists making over $1 million, as well as those generating over $10,000, has more than doubled in the past 5 years. So those of y'all making music, keep making music because y'all are making more money, at least according to Spotify. But also you get paid like not a lot of money. Most artists do not make any money on Spotify. It's totally BS. Anyway, they are looking also to add more features and reimagine their user interface. Features like autoplay for podcasts, personal visual and audio previews of podcast episodes and audiobooks or music playlists, and new feeds for discovery will be rolled out in waves starting on Wednesday, Spotify said. So starting today, y'all may be getting some funky new features on Spotify. But yeah, man, 500 million users on Spotify, absolutely awesome. And to cap off the Dylan Hoy experience tonight, I was talking earlier about how interest rates and higher interest rates play a factor into the valuations of different asset classes. One of those, if not the biggest asset class that is impacted by interest rates, is the real estate market. And last week I did a write-up over on Twitter at RealDylanHoly on the state of U.S. mortgages. And let's break it down. The average U.S. mortgage rate in 1 year nearly doubled from 3.9 to 6.9%. All the while, the value of a home has stagnated for the first time in nearly 3 years. All the while, home buying volume has cratered 36% from last year. Let's take a week-ender here. So these were taken on February 27th. So the mortgage rates were just over 6.9% for a 30-year fixed APR. With interest rates going higher, I would venture to assume that mortgage rates for a 30-year fixed are also going to go higher, but these are the numbers that we have right now. So 6.9% from 3.9% a year earlier. The median price of a home, and now it has stagnated, so it hasn't necessarily gone down yet, but if we see, dude, look at this growth. Like, it went from $320,000 to over $460,000 from 2020 to now Q4 of 2022, so nearly 3 years. In Q3 of 2022, the average price of a home went from it was valued, or the median price of a home was valued at $468,000, and now it's valued at $467,700. So the median price of a home has only gone down by $300. Peanuts. Sure, I can definitely agree with you, and while it's just under the highest it's ever been, here is the more significant number, I think, in this part of the state of U.S. mortgages. If we take a look at existing home sales being purchased, so the number of units being purchased in February of 2022 was at 6.4 million. In 2023, in January of 2023, it was only 4 million. So the amount of people purchasing homes, it's down 36% from last year. That's the big sign. And here is and here are the factors that are really playing into it. So this is a continuation from the state of U.S. mortgages. A home in America is now 50% more expensive than it was a year ago. For mortgage rates, or for mortgage payments to recede to their 2020 to 2021 levels at current interest rates, home values would have to drop 33%. There would need to be a third slashed off of a home. Now let's take a look at the median mortgage payment in America. Now, according to the HMDA, 82% of all mortgages that have been originated in the United States are conventional, meaning a 20% down payment is required at origination. The median home price in Q4 of 2021 was $423,000. With a 20% down payment, that would be $82,000 up front, with the rest financed at a 3.9% interest rate, locked in for, say, 30 years. The far and away most popular length of time to finance something, 30 years. The monthly payment on that median property in America during Q4 of 2021 would be $1,834.18. When we can take a look at it right here. So this is what the monthly payment in Q4 of 2021 would be with a typical 20% down payment, no private mortgage insurance, just a run-of-the-mill median mortgage payment. Now, if we fast forward to 2023, that same property is now theoretically valued at $467,000. With that same conventional 20% down payment, a home buyer would have to now put down $93,000, which is an 11,000% increase year over year, 12.5% as well. So right around 12%, but more importantly, an 11,000% increase year over year. And obviously, the U.S. savings rate is down too. If we take a look at the U.S. savings rate, people have less money now than they did 1 year ago. And it's like, Dylan, I don't know about that. I don't think that's the case. No. Let me show you. Look at this, dude. Like it is slightly trending upward, but like, look at where it was. Come on, baby. Let's take a wee gander here. Dude, why is it freaking out? There we go. So in March of 2021, it was at 26%. From that point, it is at 4.7%. So yes, it is slightly trending upward. That's mostly due because I think inflation is it is cooling down. I mean, it's still there. Stuff is more expensive, but it has cooled down from June of last year, for instance, which it logged its highest rate in nearly 40 years since the 80s. But people have less money to even buy groceries. So I don't think people are going to be financing a house, especially at these rates here. So with a conventional 20% down payment, a home buyer would have to put down $93,000 and finance the remainder at 6.9%, nearly double the interest rate from 1 year prior. The new monthly payment in America for the median home is $2,754. What does that mean? What does that mean? Well, the actual, and like I said earlier, the actual home, to actually finance it, a mortgage payment in America is 50% higher than where it was 1 year ago, dude. That is the reason that home buyer demand and home buyer volume has cratered 36%. Who would have thought? So as interest rates, if they end up raising interest rates and sending them higher, then I don't see the real estate market booming for much longer. It's not booming now. I mean, stuff's catching up. For anyone who locked in a mortgage at 2% or 3%, bro, they're just vibing right here, dude. They're just paying the house off, getting that equity in there for the long term. This is where you just kind of sit on your hands and pay your home off and get the equity back. I don't have enough money to buy a home right now. I'm not going to lie to y'all. But I would not buy a home right now. I actually wouldn't buy a home for the next 2 to 3 years. But I guess we're going to revisit that every time there is an update in this information, because you better sweet bucket. The Dylan Holy Experience is always doing write-ups on this kind of stuff. We always have a pulse on the market. And I think that'll bring us to a close for tonight's midweek market recap. If you like what you saw, be sure to give me a follow at Real Dylan Holy. This is where all of the information is sourced, bro. Like, this is where I get everything. This is where I'm constantly posting stuff. Whenever I'm live, I always give you guys a heads up over on Twitter at Real Dylan Holy. And of course, the key takeaways and market moves. So if you want to know what the Dow Jones and S&P 500 are doing, as well as just every company, every noteworthy thing that's happening in the market, I'm parsing with my bare hands to make sure you are getting the information that you need. Twitch.tv/RealDMH is where half of y'all are watching right now. Half of the millions are tuning at me live. Twitch.tv/RealDMH. So be sure to give me a follow. I'm always live every Wednesday, and we are going to be live on Friday. Frenzy, which is my Destiny 2 rating clan. We're going to be participating in the Day 1 World's First Race for Root of Nightmares, the new raid coming out that is attached to the Lightfall expansion. And for the other half of the millions watching over on YouTube /@Dylan Holy, we have some content on there for you right now. And of course, I'm always live in tandem on Twitch. So be sure to follow or give me a subscribe, dude. There's just all this different lingo for all the different social media apps. But be sure to subscribe on twitch.tv or youtube.com/@Dylan Holy, and turn on post notifications so you can find out when I'm live and whenever I post. So there we go. Key takeaways, not key takeaways, midweek market recap. Thank you all so much for watching. It's always a pleasure being able to do this for y'all. And I hope you guys have a good night.